When the market gets too emotional, you need to do everything you can to cordon off that whole part of your brain, because your gut feelings rarely give you good investment advice. Over the summer, there was a widespread sense of panic that threw a lot of people off the scent. You had a lot of these Chicken Little squawking that the sky was falling. I tell you that the inverted yield curve meant that we had to have a recession, and therefore the averages had to go much lower. Turns out they were dead wrong. The Fed cut interest rates, the yield curve uninverted, and the stock market roared higher. They don't talk about that much anymore, do they? At the time, I told you not to take the bears too seriously because they were ignoring everything that was going right with the economy. But it can be hard to make those judgments when so many experts are telling you to be afraid, be very afraid. That's why I always like to tell you to check your emotions at the door. When that gets difficult, when the sense of doom and gloom is just too palpable, too overwhelming, you should fall back on something maybe more objective, more quantitative approach. That's where the charts come in. Now, I myself, as you know, am not a huge believer in the charts. I think that they are very important. They're Wall Street speak for looking at the action to predict where security might be headed. I prefer to stick with the fundamentals, doing homework on how businesses are doing, and then figuring out what that means for their stocks. But fundamental analysis requires a lot of judgment calls. And when you're constantly being bombarded by big picture worries, as you know we are every day, the yield curve, the trade war, the Fed, well, it messes with your judgment, doesn't it? The charts, they don't have any feelings for any of that stuff. They're much less subjective. And that's why we run an off-the-chart segment every week. During the big sell-off over the summer, we checked in with a fellow by the name of Larry Williams. He's a legendary technician who's been trading futures, commodities, and stocks for nearly as long as I've been alive. Williams is an industry legend, a titan. He's written almost a dozen books. He's got his own website, ireallytrade.com, and he's created a legion of technical indicators that have been adopted by pretty much every chartist under the sun, like the Williams percentage R oscillator that tells you when a stock is overbought or oversold. We use that all the time. That's him. In late August, Williams made a bold contrarian call. He told us we need to stop worrying and learn to love the stock market, because the negativity had run its course and the averages were ready to roar. Since then, the S&P 500 has rallied a quick 7.3%. That's a phenomenal move and a great call by Larry. So where do we go next? Well, Larry checked in with us, and take a look at this. Let's start with two tools that let him call the bottom in August. First, check out this chart of the Cboe Volatility Index. That's the VIX for short, which is also known as the fear gauge, because it reflects the level of panic in the market. That's why the VIX and the S&P 500 tend to move in opposite directions. Now, Williams believes that there's a cycle to volatility, and he tries to predict that cycle based on the VIX's past behavior. You can see his forecast in red on the chart, okay? And remember, he nailed it with his forecast last time. How about right now? Based on the cycle, Williams is expecting a sustained upturn in the volatility index right around the end of the year, all the way here, okay? But until then, he thinks it will head lower, which means that the stock market should continue to climb, okay? That's what he's saying that should happen. Now, there's an advanced decline line that he also cares about, and that measures the net sum of advancing stocks minus declining stocks, New York Stock Exchange, on any given day. The number that goes up versus the number that go down. Williams has been following this indicator, get this, since 1962. Because it sidesteps irrational price swings, giving you a clear view of the market's breadth. When I say it sidesteps, what it means is to smooth things over so you don't have any outliers that are distorting things. When it rises, that means you've got a healthy market with lots of winners. When it fails and goes down, it means you've got a lot of losers. Just like with the VIX, Williams looks at the past action and comes up with a forecast to figure out where it's headed. And in the case of the advanced decline line, his forecast predicts a major uptick starting right about now, just like we saw in late August. That's very, very bullish. So in other words, advanced decline line, cycle forecast, moving up, okay? That'd be a nice move to catch. Now, I want you to take a look at the daily chart of the E-mini S&P 500 futures, which closely track the underlying index. Even though the S&P's been on a tear and it's technically in overbought territory, Williams sees a cycle here that's about to turn even more bullish. Now, these forecasts don't tell you the magnitude of a given move. They only predict its direction. But right now, his forecast for the S&P is screaming that we're about to go higher still. Doesn't this dovetail with what I said at the top of the show? Right? I mean, kind of pretty fascinating, isn't it? So now I'll talk about individual stocks, because this also dovetails with where I am. First, let's check out a stock that my channel will trust has owned forever. Let's check out Home Depot. All right. Now, Williams likes the action here. First, the stock benefits from a bullish seasonal pattern. The blue line, okay, that's bullish. This is how it's looked before. Typically causes retailers to rally going into Christmas. He points out that Home Depot's been outperforming the usual seasonal expectation, which suggests that the stock will really go into gear once that pattern turns extra positive in a few weeks. Second, there's this thing that he developed to find out what professionals are doing and predict it. It's called the Williams COTSI, C-O-T-S-I. It's one of his proprietary tools that helps detect whether big institutional money managers are buying or selling. Lately, they've been buying Home Depot, and they've been buying a hand over fist, and that's a very good sign. He thinks it's exactly the kind of stock that could work through the end of the year. And, you know, I'm a big fan of Home Depot long term. I got a conference call on Wednesday, and I was thinking, oh, do we have to sell some Home Depot for my trust? I trust Larry Williams so much, the answer is going to be no. Next up, there's Walmart. Now, this stock's been an excellent performer here. Williams calls it the mother seasonal strength of the retail cohort. Meanwhile, the professionals just started buying it aggressively a few weeks ago. To get in ahead of the holiday shopping spree, Williams is betting there's a lot more upside. I am with him, although I didn't, here we go, okay? Professional buying. I didn't think this was as strong as Home Depot, but I'm not going to go against him. Finally, how about this one? A lot of people feel that this is so simple to do, and yet it's been wrong for so long. I don't think it's going to be this time. It's a little bit United Parcel. Somebody has to deliver all those packages, right, that you order online. Nobody does it better than UPS. Whenever the retailers have a strong Christmas, that tends to spill over into the ancillary plays like this one. Wow, this is good. This could be big. And that's why the seasonal pattern UPS is so strong. Based on this pattern, Williams believes it's got more room to run. Now, if you remember, the stock got hit, okay, when it reported. I came out here and said that was wrong. It shouldn't have got hit. It should be going higher. That's what it's doing, and I think it goes higher still. Bottom line, in late August, when so many commentators were freaking out, coming on air, telling you how scary it is, the legendary Larry Williams told us the negativity was peaking and the stock market was poised to go higher. Well, guess what? He nailed it. So when he tells us that the average can keep running through the end of the year, along with Home Depot, Walmart, and UPS, you better take him seriously. Nick in Florida. Nick!
Back in Booyah land with the Wizard of Booyah.
Well, okay, we're not in Kansas anymore. What's up?
Jim, recently Rite Aid had an enormous run-up. Now the WBA is thinking of going private. Is it good to buy Rite Aid in hopes that it will get approached too?
No. While the balance sheet for Walgreens is suboptimal, $16 billion in debt, the balance sheet from Rite Aid is just horrendous. No one's going to load it anymore, and we're dead on that one. So I'm going to say you should not be in that stock. Do not be in that stock. Okay, let's go to Jim in New York. Jim. Oh, darn it, we're out of time. All right. Our chartist thinks the averages can keep running through the end of the year, along with Home Depot, Walmart, and UPS. I recommend taking him seriously. Okay, much more made money. JP Morgan's Jamie Dimon made $31 million last year. Got a problem with that? I'll tell you who to take it up with. Then, it's one of the biggest names in helping biotech launch game-changing drugs. But can Charles River Labs give your portfolio a healthy boost in an uncertain market? And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.